Hello, everybody. My name is Tony Croft. I work in the TaxCycle support area and answer your calls and emails. Today, we're going to talk about the new breaking news on accelerated CCA, one of the probably the biggest tax changes that can be a benefit since pension income splitting. So we're just going to go through a few different things. Today, I'm going to talk about the new triggered accelerated CCA calculations. And I'm also going to go and speak about the new Schedule 14 that affects the provinces of Saskatchewan, Manitoba, Ontario, and New Brunswick. I'm talking about this not just because of the people in those provinces, but I'm well aware that those of you in other provinces have clients that live in the provinces that will be affected by this new change, and you also probably have clients that have moved away from your home province and are now living in one of those provinces as well. And I'm also going to show you a couple little things that we've brought in now to do on our print screens, and a couple things there later. So I'm going to start off with the accelerated CCA part. So I've built my own little T1 return today. And today I'm going to be a resident of Ontario. I've put together a coupled return, and for easy viewing of this, I've made them 50% each percent partners in a small business. So we're going to start off looking at their 2125. So I've entered in a few different expenses here. I have 50% partnership. Now, I just want to show a couple things that just come up. That's not really part of the accelerated CCA, but we do get questions, especially from new users, on how do you go about doing a percentage on your 2125. So what I've done down here is we have the wife's name populating right away. I've entered in here 50% partnership. So this is where you have to designate a partnership. So you enter in the 50% here, then that'll take it to the top and we'll show 50% for the principal. Now, details of other partners. So I have said yes to include Jennifer, the spouse, and we have this question, if so, share motor vehicle expenses with Jennifer. So what I've done is said yes to this. So now I'm going to go to my motor vehicle just to show you a couple quick little things here. I've entered in the vehicle and I've acquired a new vehicle. Now I'm looking, because of this accelerated CCA rules, it's for additions after November 20th, 2018. So I'm expecting that a lot of you won't be doing a lot of clients that have jumped on this new credit and purchased assets after November 20th, but it is possible. And then going forward in the 2019 year, I assume there'll be a lot more purchases that will be affected by the new rules. So I've entered in my basic information, a few expenses. So I'm doing a class 10 vehicle, so price is under $28,000. So the net cost is $28,000. I got the GST HST for $36.40. So the total acquisition cost is $31,640. Now with the new accelerated CCA, we have the half-year rule has been waived. So now my base for CCA is going to be 47,460. Maybe I should make this just a little bit lower, because you really can't have a class 10 over 30, so my mistake there. So you'll see that we've brought in the 28,250 as the UCC before CCA. Now the base, because the 50% rule has been waived, we have to adjust the UCC. So now we have a base for CCA of 42,375. The rate is 30%. And so I'm getting a fairly large CCA claim of 12,712, but in this situation, it's not all business use. So just showing how this works. So we go back up to the top and you'll see that we have the personal amount. I've put in 3,000 kilometers total vehicle driven kilometers, and the work I've associated 1,400 kilometers. So in this case, we have the personal amount of CCA that's not included of 67 $13.80, and the CCA included for the business $59.32. So I just thought I'd show how it goes in the motor vehicles, because we do have some confusion from time to time. Now I'm going to go to the 2125 asset, where I've got some existing assets and I'm doing some additions. So here I have an existing asset, $15,000, and I'm doing an addition as well. And my addition is after the period. So what we have to do is current year additions, dispositions, we put in a transaction date. So I'm choosing November 25th, and the cost of the addition is $6,000. It is eligible. It defaults to yes for accelerated capital cost allowance. And then you will see what happens here. So I have an adjusted base of UCC of $12,000 from the original purchase. My addition is $6,000. So now I have a total of $18,000, and because of the phasing out of the half-year rule, we add back in $3,000 to the UCC. So now my base for CCA is $21,000 at 20%. So I get a $4,200 CCA claim for this year. And my ending balance is $1,380. Now I have my next example, where I've just purchased a computer, Class 50A. The total price is $2,000 for the addition. And my addition is in the accelerated after November 20th period. So once again, we have the addition of $2,000. We've got the half-year rule readjustment, so it pushes the base for CCA up to $3,000. So in this situation, I'm getting a CCA claim of $1,650 and then an ending balance of $350. And it's the first year of the addition where you get the big adjustment on the CCA. Now my next example, I've got an existing asset of $14,000. I'm doing an addition of $10,000 plus a disposition of $14,000. So then it calculates my ending cost. So here's where it gets a little bit confusing. I have a UCC beginning of $12,000, adjusted UCC of $12,000, obviously, then an addition of $10,000. Then my proceeds of disposition are $11,000. And so what happens is we have to take the difference between the addition and the disposition. So that's $1,000. So we're ending up with an extra $1,000 of UCC. So I will have an ending balance of $8,800 in this situation. Now my next example is one that can be a concern in some situations. So I'm adding a building, and the addition price is $400,000. And in this situation, because of the $400,000, now we're backing it up to $600,000. And so I'm creating a rather large CCA claim of $24,000. Now, sometimes I'm going to show in a minute here how we can adjust our claims on CCA, because you'll see in this situation that I'm technically, if I'm reducing the net income to $4,039, I'm getting a little bit of CPP on self-employment of $26.72. I have come across people in the past that tend to want to, on their self-employment, that's their only source of income, they do want to contribute more to CPP. So that's where you kind of have to adjust their income. Sometimes you don't have to claim CCA, you don't have to claim all their expenses. You do have to declare their income. But you see in this situation, so my total payable for this spouse is $53.44. Now, if I go over to the other spouse, they have the same income, same CPP, but we're creating, and we have CPP on self-employment, and we've reduced their income to basically nothing. So, which in a lot of cases is great, but in some cases you don't want to create, a loss on a business, and you get into the rules. But here's what I want to show you something. So I'm getting a workers' income tax benefit on this client of $1,269.92. Now, when the working income tax benefit first came out, I got call after call where people would say, well, every time I put an expense in, my refund is going down, and that's because of the working income tax benefit. Now, we're going to go back to the asset, and I'm going to take a look, and discussing with my client, they really don't feel that they want to claim CCA on this building. So that's fine. So what do? I can go in and delete everything. Or, now I forget how to delete. So I'm going to click here and I'm going to choose delete, because I've decided, my client really doesn't want to claim that much CCA, doesn't want to deal with recapture down the road. So now I have just the 3 items. Now you'll see that I've boosted up their income considerably. So now they're paying CPP, they got some tax payable, things have changed. And what else do we have here? And we'll see that they've lost the working income tax benefit, which, is the way it can be. But what happens now is, well, I don't really want to claim as much CCA as we've claimed. So what should I do? I've eliminated the claim on the building because that was looking, to cost too much CCA, and there could be chances of recapture down the road. So what should I do now? And we get this question quite often, is I don't want to claim that much CCA. So if we go to the T2125 CCA, and here's where we have all the items. As we showed, we got rid of the building because we just chose at this time not to claim capital cost. So here we have our CCA claim for the year of $8,050. So in some situations, you may want to say, I wish to claim a different amount. Then we provide the option, how do you want to do it? Lowest CCA rate to highest, buildings claimed at the end. Lowest CCA rate to highest. And then you can do it. How much do you want to claim? You need to. Now, the problem here is that we have to choose something to claim. And so we're going the lowest. And so we're taking a lot on this asset and a little bit more here. Is one way to adjust it. Sometimes this doesn't always work the way the client wants it or you want to do it. So in some cases, it's necessary to get the desired rates or claim is to come in and manually override. And there's nothing wrong with overriding here. You just come in, override, go to your review marks, and do a sign off. So that was a fairly quick look at the accelerated CCA. Hopefully it'll give you a start on this. You can make up some examples. And when you have clients coming in that do have the additions in this period, you can take a look and see whether it's what you need to claim in this. Every situation is different. You can claim a lot of expenses on a 2125, and then you get into the situation in some cases where you're creating a loss on the business, and whether you want to keep going on losses. I've always claiming expenses is what you want to do, but I've been in situations in the past where I start to get uncomfortable with the amount of dollar value that people want to claim for expenses. So we'll leave it up to you. So now I'm going to talk about the new climate action incentive that's effective for Saskatchewan, Manitoba, Ontario, and New Brunswick. The big thing with this credit is that it's a refundable tax credit and it's not income based. So what we have to do when you're doing a tax return for somebody that was a resident of that province at the end of the year. Once again, we have Ontario as my province today. We go down to the personal information, and we have this question, climate action incentive. So you're exempt at any time because you were an officer or servant of the government of another country, such as a diplomat. So in most cases, we're going to say no to that. The other question that has a few people wondering about is Alex a person in respect of whom a children's special allowance CSA was payable at any time? That's where a federal, provincial, or other institution is receiving money from the government authority to look after a child. So we don't see that too much, but it does happen. So now the next question is, we go to Schedule 14. So we have the base amount. Now, there is the one restriction. There's an extra credit based on where you live. So Ontario is the most complicated one because you need to scroll down to the bottom of Schedule 14 and determine if your client lives in one of these areas that does not qualify for the extra credit. Saskatchewan, it's pretty straightforward. It's Regina and Saskatoon where you're not eligible for the extra credit. New Brunswick, it's Moncton and St. John, and pretty straightforward. So here we have the base amount of $154. Amount for eligible spouse or common law partner is $77, and an amount for a single parent's qualified dependent is $77. And amounts for qualified dependents is $38. So you have to be a resident of Canada all throughout the year. If you immigrate to Canada to one of these provinces, you're not eligible. If you're in jail, you're not eligible for the credit. You have to be a resident of that province as of December 31st. If you pass away before April 1st of 2019, that person is not eligible for the climate action incentive. So that we have all the guidelines here. So in this situation with the spousal return, it's going over to the spouse, and we'll show you shortly how to change it. The problem with this is that, unfortunately, we get into a situation where you're only doing one return for a couple, which is always an annoying thing. So if you're doing that situation where just a return for one of the spouses, you need to determine who's going to claim this and not claim it on the return you're doing if you've been notified that the other spouse has claimed it. There could be some problems down the road on matching when Sierra takes a look to see and finds out that both spouses claimed the amount through different things. So in this situation, we've got an eligible dependent as well. There's a question down here that we have a warning for, because I have a dependent here, so we brought in a child. And there's a drop down. This is left blank to begin with, a qualified dependent. And in this situation, we're selecting yes. And if you've determined that your client lives outside one of the major areas that are not eligible for the supplement, then you say yes. It would be nice at some point, we'll have to look at maybe going by postal code, especially for Ontario, to automatically determine these areas. Something for the future. So now we have to pick a spot where we want to which spouse to claim it. So in this situation, we've just chosen the spouse, but the wife. But that doesn't always work in real life when you have the client sitting in front of you. You'll say, well, one will say, why does he get it? I should get it. Or I've gone through that many times. So what we want to do is we go to the optimization worksheet. What I do is I just press F4 and type in OPT. We also have the situation where we can, in this section here, we can choose who gets the working income tax benefit if eligible. But we've added also this climate action incentive. So we do a default. We let TaxCycle to decide. We try to pick, which spouse is going to benefit buy it, reduce their balance only, and increase their refund. But we have some options here. We can assign it to Jennifer, which it's already going to, or assign it to Alex. And we have to say no to let TaxCycle decide. And that's an override, but that's okay. So now I've put it over to Alex. So, you know, as I said, you will get situations like that where even though it looks good on one person, technically the other person insists that they get the credit. So, and it is a refundable credit. It's not based on income, so it's a nice little benefit. It'll help those of you that do the discount. You add a bit to a person's refund, which always makes people happy. For my last short, quick segment, I'm going to show you a couple things that we've added. I think I pestered Cameron on a couple things to get in based on what clients asked for. So I'm going to go to my T2125. Now we have situations where you do the 2125 and CRA wants to see a bit more information. Like there's information that goes on at 2125 and other statements that aren't really part of the certified CRA form, which we don't show on printing as a rule. But we have a new way to do this. So what I've done here in this situation, and we do get calls from clients from time to time where CRA wants to see where this other income. So I just put in tips in this situation. So what we've introduced is I just do a right click, print PDF form, and we have a new option here that says print as appears on screen. And so when you do that for a business statement or T776 or whatever, it'll bring in these other areas that you can print off to show to Canada Revenue that yes, you did report this income on the tax return in case they do, especially with T4As with self-employed commission and box 48 a T4A business income or professional income. So it's a nice little feature. Now this is when if you have in a situation where you're actually paper filing a tax return to CRA, this isn't what you submit to them because it's not technically certified. And another thing that I just want to show you as well that we've added. And just give me a second here. See, what I'm doing here is you see where we have smart copy. Now, in some situations, you do a business statement or a rental statement for one client and their partner, co-owner, whatever the situation is not a relative, not a spouse. So what we have now for all our business statements is that we can do a smart copy. So I can copy this T2125 on this return, open up the return for the partner, go to the 2125. And so once I've done the smart copy, then I go to the other return and I open up the 2125 and I do a paste and we put in all the details. So that works for 2125, T776, the business or the farming statements as well, farming and fishing. So nice little time saver for you. Thanks a lot for joining today. Really appreciate it and have a productive day. Thank you.